We are coming back today to explore 3 different markets using different option playbook. All right. Just now, all the speakers have covered different lenses, how to navigate the different market. Now we are looking at more the practical side of implementing some option playbook with their own sort of view, using macro signals, global shift, and also based on the volatility of the market. Yeah. So to put all this together, we believe that this session will help beginners to understand how to use option or apply option in all market condition. Yeah. Bull, bear, and sideways. Yeah. And of course, the other type of market is extreme right. Yeah. Then the first one is we look at bull market. Okay. We will give everyone a fair opportunity in a round robin. So we want to start with Isaac first. Okay. The first on bull market is how do I as an investor participate in the upside without taking big risks, okay? So when we start with you, of course, you are a technical trader, you do systematic top-down. We want to understand as a beginner, you are being bullish but cautious. So how can you use simple option approach to participate in this kind of market for the upside without committing too much capital? Yeah.
Hey, not an easy question to answer. Because really when it comes to trading or even investing, I always believe that there is no one-size-fit-all approach, right? The example that I like to give is like learning martial arts. Sometimes you think that judo is good for you, then you stick to it. You cannot ask a Wing Chun expert to take part in a MMA competition and then hope that the Wing Chun guy will actually win the competition. So it really, there's no one-size-fit-all. It should be very tailored. But long story short, when it comes to if you're a newbie in investing, if you have limited capital, as per what Kathlyn has shared earlier, right? Always start from the basics. The basics will be to go in with small size first, right? You want to keep things easy to manage. Then you buy the stock, okay, or the asset in terms of small quantity, right? Never ever jump in with your both feet wet, okay? That's the easiest basic level entry that I think I can share with beginners out there. But since today's topic is talking more about options, coming in from options angle, then I would say that simple strategies. Start with the simple strategies as per what was shared earlier, right? You can either go in with buying a simple call option, right? Or if you are not very sure, okay, you think that the markets may be coming down a bit, right? Cautiously bullish, because Isaac said cautiously bullish. So I already have the stock underlying, and there may be a bit of a pullback. Then you may want to protect your position a bit, right? To maybe short some puts as well, right? Yeah, short some puts. Correct.
So it's buying a put, buying a call, like
buying a call, yeah.
Shorting a put.
Correct.
All right. Being cautiously bullish. All
yes.
Right. Anything to add on, like using any your favorite technical indicator? Because as a technical trader, some may be curious. Oh, you're bullish. How do you see bullish? Then I implement these options.
Right. So playbook. As I think as per what I've shared with you guys, talk you through the thought process. It's always a top-down approach, right? Even just now, just before this session, I was speaking with some of our friends that what you want to do is not to miss the forest for the trees. You start with the big picture, right? You want to be in line with the longer-term picture, which is the trend. So my habit is always, it doesn't matter whatever asset class I'm looking at, my habit is always to start with the monthly chart. I want to know where the general market is moving. Then I can position myself accordingly on the lower time frame, right? So maybe I go down to the daily, the 4-hour, the 1 hour. And then when across the time frame it all links up, or is a probability game, so more or less it links up, then that is when I have a bit more confidence, a bit more conviction from a technical perspective.
Great. So we'll move on to great, good enough, yeah. So we'll move on to Kathlyn, all right? Because Kathlyn is more a systematic approach with her STPM sharing according to the global macro shift, right? So what is your view or what should beginner consider before entering option trade in a bull market? And any simple structure you can recommend for the start for a beginner option trader, yeah, in a bull market.
In fact, just now when I was talking to a few people who asked me questions, I realized a very important fundamental approach problem. Okay, first is many people that talk to me, they start from strategy first. Which option strategy? This is the wrong approach. Okay, of course, you can trade any way you want, right? So it's just not my preferred, mainly because you don't force fit a strategy to the current stock market. You look at what is the market, then you put a right strategy. Yeah. The biggest confusion I see is people don't know what is their trading style. First, you need to identify, are you a long-term investor? Or are you trading mid-term? Right? You are more trend trader. Right? So if you're a long-term investor, there's a few styles. Right? You could be a value investor, Warren Buffett style. Or you could be a growth investor. Right? I'm a growth investor, plus I also do trading. Growth investor focus on growth stocks. Okay? So these two has a different way of selecting the stocks. So if you're a long-term investor, then your approach for the options will be different. You'll be buying stocks for long-term growth, right? Your stock selection will be the great companies. Like I choose great companies first, right? I stand by, wait for the right valuation. I wait for the macro, right? When it's overvalued, but the macro cause it to come down, but it's still a great company, that's where I want to go in. But I want protection, right? When the macro has some risk, that's where covered call comes in. I buy stocks and I sell a call options to give me some downside protection. That is if I look, so that is if I see the chart is potentially sideways to some downside risk, but not a huge downside risk. Right? So you start with what you are doing first. You're an investor, then okay, what are the ways to protect your investment? Right? So, and if it's a foreseeable, more major downside, I would also buy a put option. For example, let's say I could have a couple of tech stock, okay, or the Max 7. Then from there, I would buy a QQQ put option to protect my portfolio. How many to buy? It depends on how much I want to protect my downside. So I can be 70% protection, right? You don't have to hedge. This is called hedging, right? So you have a basket of stocks, then you buy a QQ put option. So in the case of, the extreme case like COVID-19, right? Then you have an insurance, okay? But the stock is what you want to keep, right? So your put option will make you money. Up to a certain point in time, it will reach a bottom, right? Strong fundamental stocks. Then you close your put option, right? You take the profit and you allow your stocks to rebound. But you have a peace of mind. However, this strategy doesn't protect company-specific risks. So you need to understand that this is portfolio risk. If you are protecting individual company, let's say you buy a stock like Meta, okay? And Meta have coming out earnings. Then you need to protect Meta-specific risks. Right? Then you have to buy Meta-specific put option, which is expensive, or you can sell a call, which is turning into a covered call. Right? So which strategy you use also depends on your capital. Right? If your capital is big, you can do a covered call. Capital is small, but you still want to trade long-term, right? Then you can do what you call the LIPS, long-term expiry option. That means you will be buying 1 to 2 year expiry. But there will be more limited choice because not all stocks has liquidity when it comes to 1 to 2 years. So sometimes the liquidity can affect which choice you have. Like if long-term, so we start with what you are first. I think this is the biggest missing link when I talk to, they don't know what they're trading, okay? They don't know whether long-term, mid-term. Sometimes when they tell me mid-term, so what strategy in mid-term? Are you a trend trader? What is your entry exit rule for stock first? Okay, yeah, don't straight away start from the strategy. Right, so let me talk about investor first. Right? So if you're an investor, then there's a few choice of like covered calls. You can do long-term expiry options. You can do a diagonal call. It means you buy a long-term LIPS, but it's expensive. Then you can sell a short-term call. You get back some money. It's called a poor man's covered call. Okay, a cheaper version of covered call. So each one of these has its own pro and cons. You need to understand how it works in good and bad times. So from the language that I talk to people, they focus too much on the upside. But it can make money, it go up, they don't talk about downside. You have to talk about holistically, right? Each strategy has its own success rate in good and bad times, right? So you need to understand fully on that. So that's investor, right? The next one is if you're a mid-term trend trader, then how do you get in and get out? For example, what is your way to look at the stock chart? This is a reversal up when it's down. So for this one, you can do a LIPS. Okay? When the lips is no liquidity, then you can do a mid-term bull call spread. Okay? Mid-term call. That means sometimes long-term don't have, then you go shorter and shorter to see whether there's enough liquidity in options, right? So, but if it's really don't have, that's why we still need stop, okay? Right? When there's no option liquidity, but it's a great setup, it's a great stock you want to own, what do? Just because no options you don't trade, you don't do that, right? You still buy the stock. Yeah. So this is what I do, right? So let's say you do trend trading, you have leaps, you can do a call option, midterm, a few months expiry, 3 to 6 months. But if the option premium expensive, then you make it cheaper, you can do a midterm bull call. Then if you're a swing trader, you can do a call and bull call, simplest, right? But if you're intraday, then you have a lot more choice, right? You can choose the 0-day expiry options, the weekly options. So first, you determine who you are first. After you know who you are, you master the strategy of the entry-exit for who you are first. Long-term investor, what is your exact, how do you pick stock, right? How do you select stock for your strategy? For your horizon. How do you time entry and exit? When to get in, when to get out, when do you cut loss? Right? Then how do you determine the number of units to buy? Then only options come in. Yeah, then in options, you have a lot of choice. Right? Then, okay, so based on your holding period is how long, you will choose different expiry. Then is your focus on income generation or protection? Right? Let's say now, volatile, then I will focus on more conservative. Okay, I won't buy a call, I will buy a bull call. So I can sleep well. Worst case, I know, there's a limited risk. Okay?
So in a bull market, that means you are also always prepared for bearishness.
Yes. Now I'm still hedged. Just that I'm aligned with Jose, is cautiously bullish.
Cautiously bullish.
Cautiously bullish. I'm still cautious because Trump is still around.
Yeah.
Yeah, and the market valuation, right? So we are at stage 3 in S&P 500, just how I mentioned, right? So we are not at the strong uptrend.
Yep.
As an overall market, we are stretched. Now, this is the area where it's cautiously bullish. It's a year end, right? Normally we have like Christmas rally.
Yep.
But what if it goes wrong? But I don't be overly protected.
Yep.
Yeah, so I'm still hedged part of my account.
All right.
So if nothing happens, it's okay. I'm willing to pay the insurance.
Yep.
Right? And my covered call, for example, I have covered call. My covered call, I buy stock, I sell options, right? So I have a monthly premium. That premium pay my insurance.
Okay.
Yeah. So I don't have to cop up money to buy insurance.
Yeah, so it's objective, time frame, budget, timing.
Yeah. But if you are new, the simplest one, just buy a call. But when call is expensive, you buy a bull call. That should be the best way to start. Build a strong foundation first before you go through all the exotic names that you can find in options. It just make you feel great, but you're not going to get consistent like that.
Yep.
Because many people I talk to, like, when things go wrong, they don't know why it's happening.
Yep.
They don't know why it happened. Yeah.
So it's cautiously bullish is like instead of doing 1-leg option, it's 2-leg option, bull call spread. All right. So we will go to Jose next. Yeah, as the person who compare VIX and S&P. So we want to know what is a high probability setup in a bullish environment, looking at these two relationship, and also what is a one straightforward bullish strategy that you have kind of like look at based on maybe your UFO, your pivot points that you can share. Yeah.
Got you. Thanks for that. It's many questions in one, okay? So I'll try to kind of like classify them because
No worries.
When we talked about options, give you options. Next thing you know, as options experts, we can get confusing.
Yes.
So I'll try to classify things and give it some self-definition names.
Correct.
So first of all, starting from what to do if you're bullish.
Yeah, correct. What to do with bullish how you consider a high probability bullish setup when you look at S&P and VIX, these two metrics first.
Okay.
Yeah.
So first of all, I would not use VIX as a timing tool. VIX would not tell me if I'm bullish or bearish.
Okay.
VIX would only tell me if options are expensive or cheap.
Okay.
So, for example, typical right now, the VIX was 16 more or less. So let's call it low or kind of low.
Yeah.
So
below average.
Below average.
Yeah.
So we can say options are in the cheaper territory.
Yeah, on the cheaper side. All right.
So maybe let's say you have a portfolio and you want to buy VIX calls for insurance, as we discussed before. Well, now VIX calls are not too expensive because VIX is low, right?
Okay.
So, or you want to enter a bullish bet on the S&P. S&P options are on the cheaper side because VIX is low. So that is useful to know, but it still doesn't tell you if you're going to be bullish or bearish. So options are cheap. If you're bearish, you buy a cheap put.
Yep.
Options are cheap. If you are bullish, you buy a cheap call, right? So that's what you would do to get started at the very basic level. Look at the VIX so you know if it's time to buy or not to buy options. Because if the VIX was 28, right,
Yep.
and you buy options, maybe you are right on the direction and you lose money.
Yep.
Because your option premium is shrinking as the VIX is going from 28 to 16.
Yeah.
While you are making money on the direction, the option price is going down because the VIX is going down. So it's like everything we do in life when it comes to buying and selling. Forget about financial markets. When we go to the supermarket, you want to buy cheap, you want to sell expensive. So the same happens with options contracts. And therefore, the VIX is a good measurement to understand if options are expensive or cheap. At a basic level, they are, with the moomoo desktop application, you got all sorts of tools to understand cheap or expensive better, as you showcased earlier.
Yeah.
But the VIX could be very useful to understand the market. Overall, going back to the top-down approach, as we discussed as well today, is super useful. So now, scenario number one, let's say options are cheap and you are bullish. You could start, as Kathlyn just said, you just buy calls. That could be one very simple way to do it. But let's say the VIX is not cheap. Let's say the VIX is, let's call it 20 something. So now if you buy a call, you're buying a potentially expensive call. That goes against you.
Yep.
So that's when you do a bull call spread, which a bull call spread is you buy a call, for example, at this strike,
Yep.
and you sell a call at a higher strike.
Yep. To reduce the cost basis.
Correct. So you reduce the cost basis, which is also you reduce the risk. You also limit your potential for profit because the distance between the calls is the max you can make, minus the premium paid.
Yep.
Okay? Which, anyway, you're going to have an exit price anyway, isn't it? I mean, it's too romantic to think that you're going to go to the infinite with your stock, isn't it?
Yep.
So you would always have a target, right? So having a bull call spread where you buy a call and you sell a call is definitely very adequate.
Yep.
And then the other beauty is that, let's say you were wrong with your VIX assessment, and the VIX that is expensive is about to become more expensive. Or the VIX that was cheap is about to become cheaper. So you were wrong on the VIX. Let's say that's the case. Well, because you buy an option and you sell an option again, they kind of almost offset each other.
Yep.
So it's almost like you are eliminating a lot of the problems of getting the direction right and losing money with options and you didn't know why.
Yep.
So doing option spreads, which doing a bull call spread, buying a call and selling a call against, or buying a put and selling a put against, like combining two options at a time, we call this technically options spreads.
Yep.
And that really reduces the risk, but also reduces the pain if you are wrong on the VIX, which is, what if my options become more expensive and keep becoming expensive? What if my options were cheap, but they becoming cheaper?
Yep.
So that would be answer number two, right?
Yep.
So answer number one, if the options are very cheap, you
Yep.
just buy a call.
Yep.
Option number two, you don't know if options are that cheap.
Yep.
You may think they are a bit expensive or about to become more expensive. So maybe you do a bull call spread. And this is one very simple and very, very efficient way to kind of like hedge yourself from within your option trade. And then option number three, now you open the door to the million different ways to use options. So I'll add one spin here. Because most of my conversation, at least earlier from my angle, was kind of like short-term trading. So I kind of never provided answers to the long-term investors in the room, which should be some of you as well, I'm sure. So maybe let's say now you are bullish, but you are thinking about long-term.
Yep.
Right? So with options, you could approach it from different manners. You can be very simplistic as just selling a put. So let's say the S&P is trading at, I'm going to use round number 6,000.
Yep.
And let's say you are like, okay, 6,000 is too expensive for me, but if the S&P was to retrace to, let's say, 5,500, I want to own it. Or instead of the S&P, maybe it's your favorite stock. Like you want to own NVIDIA, but not at the current price. You want to own NVIDIA at a lower price.
Yep.
So you sell a lower strike put.
Yep.
So if NVIDIA goes down, NVIDIA is put to you.
Yep.
Right? So that's just you talked about the wheel strategy.
Yeah,
so that's
correct.
classical, but here's the spin.
Yeah.
The spin is, instead of you do the wheel strategy, you sell that lower put to get the stock you want long term.
Buy the stock at a discount.
Mhm.
Buy the
But now,
index
instead of
index.
waiting to buy the stock at a discount, you use the premium collected from the put to buy a call.
Yep.
So now what happened? If the stock breaks up, never came back down to the price you wanted, the stock keeps going, you're in because you own a call.
Yeah.
But you didn't have to pay for the call. The call was financed by a put you sold. So again, I'm hesitant to get deeper into these type of combinations because it may become confusing as a conversation, but it's very simple in the end if you think about it. You sell a put, okay, which means I want the stock put to me. So you authentically need to want that. Okay, if you don't want the stock put to you and you don't have the capital to own the stock, don't do it.
Yep.
Because you're gonna get a margin call, potentially, right? So don't do it. But if you authentically want the stock at a certain price below current price, you sell a put there, collect the premium from the put, and buy a call above. So now if the stock rallies from now, you are making money with it very efficiently with the call you own. And if it goes down, right, and you sold a put, let's say 10% below, so as long as the stock doesn't drop 10% or more, you will see your P&L fluctuate, but you're not losing anything until the day the option expires. And when the day the option expires, two things may happen. You are below the strike and the stock is put to you, or you are above the strike. And if you are below the strike and you own the stock now because it's put to you, that's what you wanted. That was the beginning of the story, right? So it's very efficient for long-term investors who authentically want to own the shares.
Yep.
If not, don't do this, okay?
Yeah.
There are other variations, of course. Maybe you can do, okay, I'll add one
No worries.
little
Final
thing
one,
here.
yeah.
Just for, some of you said you have been trading options for years, so you'll appreciate this. So if you want to do something in between, which is not long-term and short-term, let's call it swing trading. So what you could do is, instead of selling puts below price, you can sell put spreads below price. So you limit the risk below, and because the put spread will pay you less, maybe you sell 2 put spreads, and in exchange for the 2 put spreads you sold, you buy a call. So you're kind of replicating the same thing I just said for long-term investors, but now you are a swing trader. You are giving yourself a buffer where the stock could drop against you by a certain amount. And if it's put to you, it's limited risk because it's a put spread. It's not a naked put, it's a put spread. And if the stock goes up, which is you're bullish, you were right, so you start profiting with that call immediately. And the call was paid from the credit from the 2 put spreads. So it's beautiful. There are so many possibilities. Okay, the danger here is that, maybe I'm actually stepping over the line. It gets a bit too complicated because we add too many combinations as possibilities, and it gets confusing. But the reality is that, you start from the beginning, as Kathlyn said, you know your call, your put, then you know what happens when you buy the call, when you buy the put, then you know what happens when you sell the call, when you sell the put, and you start combining things, and you line up your trading style with the market environment from a top-down approach, with the option strategy that gives you the greatest advantage for that environment and your style. And that's what it's all about.
All good. Yeah. All right. I guess for the bull market side, everyone is cautiously bullish, in agreement, and they are whatever you have learned today is neutral bullish option strategy. Yeah. What we share on the floor. So we move on to the next one, which is the bearish side of the market. All right. So the bearish side is, of course, we need to learn how to protect ourselves during market downturn. Right? It falls like 5%, 10%, then 15, 25%, black swan. So this is what is the real test of real traders who survive, right? So I start with Kathlyn first, okay? So Kathlyn, based on your workshop, you always talk about different risk requirement based on option tools that you can sort of customize your risk accordingly. So when a beginner, they experience this market downturn, is there the simplest way to protect their portfolio instead of using a particular option strategy? Your top-down, your systematic approach.
The most important is you need to have a systematic approach to look at the chart. Example, why do you buy the stock, right? So we have the STPM process, right? So first, select the strong fundamental stocks, right? Then you know exactly your entry, exit, right? So we have look at the trend. Is the trend up? Yeah. Is there a pattern to trade? Is the reward always good? Then we keep to 1% risk if I'm wrong, right? For options, because you don't have a gap down, you can max the 2% total loss as well. Okay, so you can use that approach. But if there's no momentum, you can still close it, right? So 2% is still money.
So fix the risk, having defined risk option strategy.
Yeah, right. So that's the systematic approach. Then you pick the right option strategy. So for beginners, normally, if you want to, options is a more sophisticated instrument. But it's really worthwhile for the long term. But it takes time to master, right? So I remember when I first learned it, I had to sit down and internalize the risk profile. Why is it like that? And after you trade for a while, that's why you start with the basic one first. Don't get complicated, right? The call and the bull call, right? So when the stocks go up, how much the premium go up. Then there's concept about delta and implied volatility. Okay, so these are the more sophisticated things. But once you do the simple strategy and you learn how it works, then when you combine, then you think about being a seller, right? After teaching for 17 years, okay, I trade for 30 over years, but I teach for 17 years. I realized that most people confuse being the seller part. Okay, so being a seller, how does it work? So you need to experience that. And when you combine, how does it work? Yeah, then you will have a solid foundation to combine in many manners. Right? So if you want to protect the risk, I would say the total peace of mind should be a buyer, and the lowest risk would be bull call spread. Right? Depending on whether you keep positions overnight. Yeah? Of course, people say that intraday is lower risk, that is the cheapest cost. So if you trade your intraday based on, you already know this is your max 1%, right? If it doesn't work. But you also need to look at success rate, right? 1%, but 90% loss also is a problem. Okay?
Yep.
Yeah. So this is one of the important part. But I think I want to highlight one of the misconceptions, even though it's probably not part of the panel. Is it okay for me?
Yep.
Is it my
Just a quick
my
one because we are running out. Yep.
But the most common mistake I see, and also advocated by many people, which is you should be a seller.
Seller.
Because most of the time, options expire worthless. Being a seller, your success rate is higher. But most people miss out the concept of reward over risk. Because most people don't like to be wrong. Who like high success rate here? Raise your hand. Who don't like high success rate? Everyone like high success rate. So it's very easy to sell a course based on high success rate. But what people may not tell you is, most high success rate strategy in options has low reward over risk. High success rate, when you win a lot, but when you win a little. When you lose a lot. Right? So you could be 80% right, you could be 90% right, but you cannot tolerate a lot of losing trades. Actually, to me, after trading for so long, low success rate but high reward over risk strategy is actually better. Because when you win a lot. Let's say you have a 3-to-1, right? One win, cover 3 losses. One win, cover 3 losses. You only need 25% right to break even. 25% right. 30% and above, you make money. So you can tolerate a lot of loss, and when you win, you have unlimited upside. When you win, you can win a lot. The market is bullish. When you detect the directional part. Yeah, so there's so much misconception about, being a seller. Like, let's say when you, I don't have time to talk about, so I have a 1.5 hour. I'm going to talk about the being a seller and even the cash secured put. I can talk 1 hour about that.
Yeah. So we leave it as one takeaway from the other two speakers for the bear market, because I think the sideways market is more interesting, right? With option. Yeah. Maybe one sentence from Isaac first. Jose first. Sorry. Jose, one sentence. Then Isaac, one sentence.
Trading successfully is all about managing risk. Given the fact that option strategies allow you to predefine risk before you even execute your trades, options trading kind of forces you to be systematic and focus on risk. So it's a very powerful way on how to trade.
All right, good. Isaac.
I think I'll just borrow the quote from Paul Tudor Jones, who is one of my favorite fund managers and traders alive. He mentioned that you can be a complete newbie at trading, but as long as you have that risk reward of 1:5, you can lose 5 trades, but on your 6th trade, you cover back all your losses. It's exactly just like what Kathlyn said and what Jose said. I think risk management is very, very important for any trader or investor.
Great. So just one final one, because we are left with the final 60 seconds. So in the sideways market, what is the most interesting thing you have as a takeaway from each of you as one sentence? Yeah, Kathlyn first. Yeah. Okay. Sideways.
For
if
sideways
market don't move, it's dead.
Yeah, sideways market, you want to generate income.
Yep.
There are expensive strategy and cheap strategy. Expensive strategy is for investors. You buy stock and you sell a call, right? You collect rental income. And you also get extra dividend if it's a dividend stock, right? I don't focus on dividend stock. I focus on high cost. So cheaper strategy is called a bull put spread. Right? As long as stay above the support, you collect money. But you need to do it in the right market. Yeah. So it has to be at least sideways to up, right? Okay. Not when there's a lot of, not when the market is stretched, But the good thing is it is still a limited risk. It's not sell naked put. Right?
Yeah.
That means sell. Bull put strat means you sell. Let's say this
The
strong
price
support.
is neutral,
This is a
bullish.
strong support.
Yep.
You sell a put here and you buy back a put to protect it.
All right. Great.
Yeah.
Yeah.
So what you sell, you collect more premium than the protection, then you collect money.
So that's bull put spread.
Yeah, bull put
Isaac
spread.
would be
I think to keep it simple.
simple.
Yeah.
Yes.
If all these strategies are very complicated for you guys, on the moomoo platform, we actually do have covered call ETFs. You can go and read up on it as well. So that also sort of help you generate income in a sideways market. That's something to consider.
All right. Yeah.
Very nice. For me, I'll just point at what I shared on the slides earlier with the iron condors.
Iron condo. Yeah.
The only thing I will add to that is that what I showed on the slide was just like a static, passive way to do iron condors. You put it there and you forget it exists until
Yep.
it expires.
Yep.
Where the reality is that you can also manage the trade and move strikes up and down and do all sorts of things.
Yep.
So that makes you non-directional, but also adaptable to slight changes.
Yep.
So that's very, very powerful to do.
Great. Great. Yeah. So it's a wrap for this session. We want to move on to the next session. Thank you very much for the panel speaker. Yeah.
Can I just highlight one thing, which is on leverage? Leverage is very risky. So options is cheap when you buy a call, but don't use your whole account and buy a call. You can still wipe out your entire account.
Yep.
So you must determine if you lose, how much you're going to lose concurrently. Okay, so that's my last advice. Yeah. Thanks.
Yep. All right. We will move on to the next session. Yeah. Thank you so much. I'll pass the floor back to the MC.
Thanks.